Supermicro Computer Inc. closed Friday's session sharply higher, finishing the day up 11.4% at 34.38. However, momentum cooled slightly in after-hours trading, and with the stock slipping 0.9% to $34.06, trimming a portion of the day's rebound. The move capped off a turbulent and emotionally charged week for hardware stocks tied to artificial intelligence, where rapid gains, sudden pullbacks, and sharp sentiment swings have become the norm rather than the exception. The timing of this price action matters. Investors are increasingly recalibrating how they approach the AI trade, no longer treating the sector as a single monolithic theme. Instead, capital is splitting between companies that enable AI infrastructure, such as chip makers, server manufacturers, and data center equipment providers, and firms that may struggle to absorb the economic disruption created by AI adoption. This divide was highlighted by Charu Chanana, chief investment strategist at Saxo, who noted in a client comment that investors are differentiating between who enables AI and who may be disrupted by it. That distinction is now shaping portfolio positioning, valuation tolerances, and short-term trading behavior across the sector. Supermicro sits firmly in the AI enabler category, supplying servers and data center systems optimized for GPU-heavy workloads. That positioning is reflected clearly in its latest financial results. According to its February 6 report, net sales surged 123.4% to $12.68 billion for the quarter ended December 31. The primary drivers were accelerating data center shipments and a major design win with a single customer, both of which boosted volume sharply in a relatively short period. On the surface, those numbers present the picture of a company riding the crest of the AI infrastructure wave, converting industry demand directly into top-line expansion at a pace rarely seen among established hardware vendors. But beneath the revenue surge, the cost structure tells a more complicated story. Gross margin slid to 6.3%, down sharply from 11.8% in the same period a year earlier. The company attributed the compression to several factors: higher production costs, expedited shipping tied to the rollout of new AI GPU platforms, and a $142 million increase in tariff expenses. Inventory write-downs also rose, while vendor rebates declined, compounding pressure on profitability. In short, while Supermicro is shipping more product than ever, it is doing so at materially thinner margins, a dynamic that complicates how investors interpret headline growth. This margin profile highlights the operational intensity behind the company's expansion strategy. AI servers are not commodity systems. They require specialized components, high-performance cooling solutions, and increasingly complex integration to support cutting-edge GPU platforms. To meet delivery schedules demanded by hyperscale customers and large data center operators, Supermicro has leaned into expedited logistics, higher-cost sourcing, and accelerated production cycles. That approach can fuel revenue growth in the short term, but it also leaves the company more exposed to shifts in component pricing, tariff policy, shipping constraints, and inventory mismatches. The filing also disclosed that customer A accounted for 71.6% of accounts receivable. That level of customer concentration introduces an additional layer of risk. When a single buyer dominates receivables, even modest changes in purchasing cadence or payment timing can have an outsized impact on working capital and cash flow. In strong demand environments, concentration can amplify growth. But in periods of hesitation, delayed orders, or renegotiated terms, the same dynamic can quickly stress liquidity, regardless of how strong revenue looks on paper. Beyond operational considerations, the report referenced an SEC subpoena and disclosed a pending motion to dismiss in a securities class action, scheduled for a March 12, 2026 hearing. While these matters do not change the company's current operating performance, they add legal and reputational uncertainty to an already volatile investment narrative. In markets driven as much by confidence as by cash flow, unresolved regulatory and legal issues can amplify downside risk during periods of broader sector weakness. For traders, the setup is increasingly clear. On one side of the ledger, Supermicro's sales growth reflects the undeniable strength of AI server demand. Data centers continue to scale rapidly, GPU clusters remain supply-constrained, and customers are racing to deploy compute infrastructure that can handle increasingly complex workloads. From that perspective, Supermicro's surge in shipments and design wins signals strong positioning within the AI hardware supply chain. On the other side of the ledger, however, the filing's cost breakdown paints a less forgiving picture. Logistics expenses, tariff impacts, and inventory write-downs are eating into margins, reducing the financial leverage typically associated with high-growth periods. When gross margins compress to the mid-single digits, even relatively small cost fluctuations, whether in components, freight, or regulatory fees, can disproportionately affect earnings. In that environment, revenue growth alone becomes insufficient to support valuation expansion unless profitability stabilizes or improves. That trade-off creates a fragile equilibrium. The company's current approach works, right up to the moment it doesn't. As long as demand remains strong and supply chains cooperate, volume can offset margin pressure. But with margins this slim, any disruption, fresh tariffs, higher GPU pricing, delayed shipments, or shifts in customer ordering behavior can quickly translate into earnings disappointments. Unsold racks, excess components, or partially configured systems risk lingering on the balance sheet, tying up capital and amplifying inventory write-downs in future quarters. Customer concentration compounds this risk. If a single buyer controls the majority of receivables, even minor operational or financial shifts on their end can ripple directly into supermicro's cash flow profile. Payment delays or purchasing slowdowns can create funding pressure, regardless of how strong the company's order book appears. In hardware businesses with thin margins and heavy working capital needs, cash flow stability often matters more than revenue growth when it comes to sustaining operations and investor confidence. Competitive pressures further complicate the outlook. The server market remains intensely competitive, with major manufacturers and hyperscale operators exerting constant pricing pressure. Larger players benefit from scale advantages in procurement, logistics, and manufacturing efficiency, allowing them to compress margins across the supply chain. On the other end of the spectrum, smaller and mid-sized players face the risk of being squeezed out if customers consolidate suppliers or demand tighter pricing terms. As investor enthusiasm for anything with AI matures into scrutiny of actual profitability and return on invested capital, companies that rely purely on volume growth without margin expansion may struggle to sustain premium valuations. Friday's rally, therefore, sits at the intersection of two powerful but opposing forces. On one hand, the market is rewarding companies that directly benefit from AI infrastructure spending, and Supermicro's revenue growth places it squarely in that camp. On the other hand, the sharp decline in gross margin, elevated cost structure, customer concentration risk, and legal overhangs introduce structural vulnerabilities that limit how aggressively investors may be willing to chase the stock higher without clearer signs of operational stabilization. That tension sets the stage for Monday's session on February 9. Traders are watching closely to see whether Friday's rally holds at the open or whether the after-hours dip prompts additional selling pressure. The early price action will offer clues about whether momentum traders remain in control or whether risk management and profit-taking dominate. Beyond the immediate tape, market participants are also scanning for signals of margin stabilization, commentary on cost controls, and any incremental disclosures regarding the SEC subpoena and legal proceedings. The March 12, 2026 court date referenced in the filing looms as a longer-term catalyst, but near-term attention remains fixed on operational execution. Can Supermicro sustain its blistering revenue growth while restoring margins closer to historical norms? Can it manage logistics, tariffs, and inventory with greater efficiency as AI server volumes scale? And can it diversify its customer base enough to reduce dependence on a single dominant buyer without sacrificing shipment momentum? Until those questions are answered, Supermicro's stock is likely to remain volatile, buoyed by AI demand but constrained by profitability risk. Friday's 11.4% surge and subsequent after-hours pullback illustrate that dynamic perfectly. Enthusiasm for AI exposure colliding with caution over execution, costs, and concentration risk. In the current market environment, where investors are increasingly selective about which AI-linked